So it reads Somolo Limited is a firm operating in the manufacturing industry. So the firm current capital structure is given as follows. So you are given ordinary share capital. The bar value is given as 10 shillings. Total amount is 80 millions. Reserves 20 million. 10% irredeemable debentures. Capital is 100 shillings per value. Total amount is 30 million. They also gave you 8% preference share capital, shillings 20 per value. The total amount is also 20 million. So additional information, note number 1, current market price per share of the firm's ordinary share is 34.80, which is dividend. But we should always use X dividend. We subtract dividend from that figure to come up with the X dividend. The firm will adopt a 40% dividend payout ratio. Note number 3, the most recent earning per share is 8 shillings. Note number 4, historical dividend per share over the last 4 years are given as follows. Then they also gave you the note number 5, whereby the firm's management is contemplating to invest in a project which will cost 40 million. The project is expected to generate 9 million each year in perpetuity. Then note number 6, the project has an estimated beta of 1.5. Note number 7, return from well-diversified market portfolio is 18%. Note number 8, debentures are considered to be risk-free and are valued at par. Note number 9, existing 8% irredeemable preference shares are currently trading at least 25 each. Note number 10, the corporate tax rate is meant to be 30%. So now required, the firm return on equity using the Gordon growth approximation method. Then Roman letter 2, existing weighted average cost of capital. So that is now the area which will be able to come across. So the Roman letter 1 about the return on equity. That return on equity is simply the 2 methods of computing the growth rate. We normally start with the compounding method, we get the growth rate. Then we use the retention ratio method. Then in that formula for the retention ratio method, we make the return on equity to be the subject. Then we shall come up with a value for that. Then once we have done that, we can now go to the Roman letter 2 to get the Wscc. So in the Roman letter 1, they are simply asking you to use the 2 methods of calculating the constant growth rate. So the first one is the compounding method. The first one is meant to be the compounding method. So we use the compounding method. We use the compounding method to get the constant growth rate. So under the compounding method, G is supposed to be given by N, then Dn divided by Do, then you subtract 1 at that point. So G is supposed to be given by Dn divided by O, so N then we minus 1 at that level. So in that question, you got the note number 4. 2015, we name it as DO. 2015 will be DO. 2016 will be D1. 2017 will be D2. 2018 will be D3, which means N is going to be 3. N will be 3. So our G should be equal to N will be 3, then D3 divided by DO minus 1 like that. So given that information, it means that D3 is the dividend per share in the year 2018. They have given you 4.8. So you take 4.80 divided by DO. DO is the dividend per share in the year 2015. They have given us 4.0. They were able to give me 4.0 like that. Then now we minus 1 in that order. So compute that G and express it as a percentage. So online, you give me the figure that you are coming up with at that point. Anyone who has computed, you give me the figure. 6.27. Yeah, so I'm told it is 6.27. We get 6.27%. Then now after that, we use the retention ratio method so that we come up with return on equity. Under the retention ratio method, when using the retention ratio method, when applying the retention ratio method, G is supposed to be given by, so we are now using the retention ratio method. We now apply the retention ratio method. When using the retention ratio method, G is supposed to be given by R, then multiplied by the return on equity. When using the retention ratio method, G is supposed to be equal to R multiplied by the return on equity. So we make return on equity to be the subject. Once we make the return on equity to be the subject, to be given by G divided by R. So G is what we have just calculated, the 6.27. which is the same as 0.0627 like that. Then we divide by R. They gave you dividend payout ratio. You can see the dividend payout ratio. The firm adopts 60% dividend payout ratio, which means they retain which percent? So 40% is the same as 0.4. So now we can come up with the return on equity on the basis of that. We make so that we make the return on equity to be so when you express it as a percentage, it is giving you which percent? Sorry? 15 points. Yeah, so online you are getting which figure? Anyone who has computed online, what should be your return on equity when you express it as a percentage? 15.7. So that is now on that element. So 15.67. That is now what was meant to be the Roman letter 1. So codon is the same as the methods we normally use to compute the constant growth rate, but that's now at the junior level in your financial management. In your financial management, in level 3, section 3 is where you are learning the Gordon's valuation model. But for now, we just apply it as part of the methods we apply to get the constant growth rate. There are normally 2. We learned that when you are dealing with the breakpoint. So we go to Roman letter 2. We now go to the Roman letter 2, where they require you to get the Wscc. So to compute the Wscc, we should get the cost for the retained earnings. So this question had also debentures and also the preferred shares. So let us compute the cost of the ordinary share. So we shall be able to compute the cost of the ordinary share. So we start with the cost of the ordinary share. Cost of the ordinary share is the same as KE. Remember, it is DO in the brackets of 1 plus G divided by PO minus the flotation cost. Then you add G at that point. Then we had stated that DO is the last dividend that was paid, which means our DO should be the dividend in the year 2018. This one is 2018. So our DO will be the dividend in the year 2018. So dividend in the year 2018, it is 4.80, then 1 plus G. G we calculated, it was 2 points. It was 6 points. So that was the same as 0.06. Like that. Then we divide by PO. PO is the current market price in the note number 1. But you can see it is termed dividend. We said we use X dividend. So you take the 34.80 minus the dividend in the note number 4 in 2018. You see this dividend of the 4.8. So you minus the 4.8 from 34.8. So we shall be left with what price? So you confirm whether there is any flotation cost that is given. Are we able to see any flotation cost anywhere? Yeah, so it looks like it is not there anywhere. So we assume it is 0. Then you will also add 0.0627 and also express it as a percentage, and also express that as a percentage. $23 points. 23.27. So after the cost of the ordinary share, we should now also compute the cost of the preferred share. We should also compute the cost of the preferred share. We should now also be in a position to calculate the cost of the preferred share. So cost of the preferred share, cost of the preferred share. So it is the same as KB. It is dividend divided by PO minus the flotation cost. Then we express it as a percentage. So we check the dividends. It is there in the capital structure. Dividend is normally computed on the bar value. So when you check in the capital structure, you are told that 10%, 8% preference share capital. In brackets, the bar value is given as 20. So dividend will be 8% of 20. 8% of 20 shillings. The dividend will be 8% of 20 shillings. So what should be 8% of 20? 1.6 will be 1.6. So now we can get our KV. So 1.6. Then I want you to confirm in the note number 9. You can see the note number 9. The existing 8% irredeemable preference shares are currently trading at how much each? Yeah, so our PO is 25. There is no flotation cost given. Then also express it as a percentage. You'll also then express it as a percentage. So it is going to give us around which figure? Yeah, so finally, we also compute for the debenture. We also compute the cost of the debenture. We should also be able to come up with the cost of the debenture. We should also be able to come up with cost of the debenture. So when it comes to the cost of the debenture, it is the same as KD. Because it is irredeemable, it will be given by interest. Then 1 minus the corporate tax. Divide by the current value for the debenture. Then we should be able to express it as a percentage. We should be able to express it as a percentage. Interest is computed on the bar value. Interest is computed on the bar value. So when you go through the capital structure, they have given you 10% irredeemable debenture capital, and the bar value is 100. So it will be 10% of 100. We get 10% of 100, which is going to be 10 shillings. So our KD should be equal to 10, then 1 minus the corporate tax. Current value of the debenture, we got the note number 8. They said that debentures are considered to be risk-free and they are valued at par. So the bar value is the same as the current value, which is 100. There was no flotation cost. Then now you express it as a percentage. There were no flotation costs. Then also express it as a percentage. %. So after that, we should now be able to compute the Wscc. We can now come up with the Wscc. So Wscc will be given by weight of equity, cost of equity, weight of the preference shares, the cost of the preference shares, weight of the debenture. The cost of the debenture is always after the tax. The cost of the debenture is always after the tax. So we use the total market value. We use total market value. We use total market value. So under the total market value, we start with the one for equity. We start with the one for equity. So it should be the number of the ordinary shares where you take 80 millions divided by the bar value, which is 10. Then current market price, which was ex-dividend. So multiplied by 30 shillings. You take the number of the ordinary shares multiplied by the current market price, which is 30 shillings. So that will be able to give us around which figure? Sorry. We get 214 millions. Then the next one will be the preference shares. The next one is meant to be the preference shares. So for the preference shares, when it comes to the preference shares, it will also be 20 millions, also divided by the bar value, which is 20. Then current market price was 21. Was this 25? Yeah, the preference shares in the note number 9, they were currently trading at 25. So that will give us which figure? 25 millions. Yeah, so this one should give us 25 millions. Remember, you just take the number of the preference shares, not by the current market price. The number of the preference shares, you got the capital structure, it is 20 million shillings. The bar value was 20, so you divide, come up with that. The next one will be now the debentures. We also have, so debentures were being valued at par, so it will not change. So you just take the 30 million, divide by the bar value, which is 100, but they were still trading at what? At par. So the bar value is still 100. So now it will be 30 million. So you add them together. You add them. It will be 200 and 295. So once you have done that, you should now go to the Wscc. We can now come up with the Wscc. So Wscc will now be equal to. So the proportion for equity is 214 millions divided by the total 295 millions. So multiplied by KE. KE to be part of percent. The cost for the ordinary share, it was 23.27. Then the other one is meant to be 25 millions. We also divide by 295. So what was the cost for the preference share? 6.4. Then also this other one will be 30 millions, also divided by 295 millions. So KG after the tax, it was, so that figure is already taxed, don't tax it again. So don't tax that value again. So you just present it in that order. can now go to the Roman letter 3. So it is giving us which value? 20.18. Others are getting 20.18. So that should now give you a Wscc. So let us now go to Roman letter 3. Roman letter 3, they wanted you to compute the project risk adjusted discounting rate. The project risk adjusted discounting rate. So that is simply CAPM, and it is one of the techniques we use to measure the risk. We have not done the topic of the methods of dealing with the risk. When we get there, we shall do it. But for now, I'll just simply show you how to get the risk adjusted discounting rate. Let us now come up with how to compute the risk adjusted discounting rate. How to compute the risk adjusted discounting rate. So to calculate the risk adjusted discounting rate. So risk adjusted discounting rate. Discounting rate. It is simply the formula of the security market line. It will simply be the risk-free rate, then expected return of the market minus the risk-free rate, multiplied by the beta factor of equity. So to compute the risk adjusted discounting rate, it is simply the security market line. When we use it to get the cost of capital. So in the question, in the note number 8, debentures are considered to be risk-free. When the security is risk-free, the return of that security will be the risk-free rate. We noted something of that type when we are doing the portfolio theory. When a security is risk-free, the return of that security will be risk-free rate. So maybe you can just add there a note. You can just add there a note that when the security is risk-free, when the security is risk-free, then the return of that security, will represent the risk-free rate. The return of that security would represent the risk-free rate. So this is now how we shall calculate it. The return, the risk adjusted discounting rate. So risk-free rate is the interest rate on the debenture, which is what percent? Interest on the debenture is 10%. You see that 10%? The now expected return for the market was given to you in the note number 7. Return on a well-diversified market portfolio is given as 18. We also subtract 10. The beta factor of equity was given in the note number 6, which was 1.50. So that we come up now with the risk adjusted discounting rate. We now come up with the risk adjusted discounting rate. So it should be able to give us what percent? 22%. So that is now all about that first thing. Is it 22 or 23? 22. So that was now the net income theory. It was the first theory. Let us now go to the theory number 2. We can have theory number 2. So theory number 2 would be net operating income theory. Remember, we are on the types of the capital structure theories. The first one was the net income theory. But number 2 will be net operating income theory. We got number 2 as the net operating income theory. Net operating income theory. the net operating income theory. We now go to the net operating income theory. So when it comes to the net operating income theory, we can introduce on that by noting that under this theory, the capital structure is irrelevant. Under this theory, the capital structure is irrelevant. Under this theory, the capital structure is irrelevant. It is irrelevant since it will not affect. Since it will not affect the value of the company and Wscc. Since it will not affect the value of the company and the Wscc. It will not affect the value of the company and Wscc. Then we continue by noting that in its initial investigation, the theory operated under the following assumptions. The theory operated under the following assumptions as summarized in the diagram. In its initial investigation, the theory operated under the following assumptions as summarized in the diagram below. So this is now our diagram. So this is now meant to be our diagram. So this will be now our diagram. So in our diagram, so this side will be leverage. Then this other side will be cost of capital, So this will be KD, this will be KEU, that will be KEL. Then so KEU is the cost of equity of an levered firm. KEL is the cost of equity for the levered firm. So we had already discussed those terms. So KEU is the cost of equity of the unlevered firm. KEL is the cost of equity for the levered firm. Then KD is the cost of the debt. KD is simply meant to be the cost of the debt. Then we know D over E, the proportion of the debt divided by the proportion for equity. Then now it must be after the tax. So we shall be getting to know more on that when we shall be able to demonstrate that information. So after that, now we can add there a paragraph by noting that According to this theory, comma, cost of equity, according to this theory, comma, cost of equity is affected by both financial risk, the financial risk and the business risk. It is affected by both the financial risk and business risk. Then we continue by noting that as leverage increases, comma, the equity shareholders would demand higher returns. As leverage increases, comma, the equity shareholders will demand higher returns. They will demand higher returns in order to be compensated. For the increased financial risk. Then another paragraph, we note that since the equity shareholders are well compensated, for the increased financial risk. They are well compensated for the increased financial risk, comma, their perception about the company will not change. Leading to the conclusion that the capital structure is irrelevant. Then another paragraph, not that. Therefore, there is a contradiction between net income theory. And net operating income theory. Then you continue on the same by noting that this conflict was resolved by Franco Modigliani and Morton Miller. So the conflict was resolved by Franco Modigliani. This one is I, Franco Modigliani. It was resolved by Franco Modigliani and Morton Miller. Franco Modigliani and Morton Miller. So it was resolved by Franco Modigliani and Morton Miller in their theory known as MM MM proposition, known as MM proposition, So now we can have a subtopic as MM proposition. So we can have a short break for those who are going for the prayers, so that when we come back, we shall now start on the MM proposition. So let us have a short break from that point. So we now go to the Modigliani and Miller as a new proposition. So it is one of the theory that we shall be dealing with most when it comes to determining the value for the firm and also the Wscc. So let us write something on the proposition. We can note that in their first proposition, in their first proposition, in their first proposition, comma, they dealt with the value of the firm. In their first proposition, they dealt with the value of the firm. They dealt with the value of the firm. They dealt with the value of the firm, and they concluded that. And they concluded that there are no two identical companies. They concluded that there are no two identical companies. There are no two identical companies which can attract different values. There are no two identical companies which can attract different values. Which can attract different values simply because one company is levered, and the other company is unlevered, simply because one company is levered and the other company is unlevered. One company is levered and the other company is unlevered. Then another paragraph is that argued that if the two companies attract different values, argued that if the two companies attract different values, if the two companies attract different values, then the investor will practice. Arbitrage process. Investor will practice arbitrage process. The investor will practice the arbitrage process, in order to restore the value of the two companies. The investor will practice the arbitrage process in order to restore the values of the two companies, in order to restore the value of the two companies to equilibrium, in order to restore the value of the two companies to equilibrium, in order to restore the values of the two companies to equilibrium. Then another paragraph, to note that the arbitrage process operates under the following assumptions. The arbitrage process operates under the following assumptions. The arbitrage process operates under the following assumptions. They operate under the following assumptions. Number one is that there is a perfect and efficient capital market. There is perfect and efficient capital market. There is perfect and efficient capital market. Number two is that both individuals and companies, both individuals and companies can borrow and lend out. They can borrow and lend out. They can borrow and lend out any amount of money. They can borrow and lend out any amount of money at the risk-free rate. They can borrow and lend out any amount of money at the risk-free rate. Then another paragraph, we note that under these assumptions, arbitrage process operates as follows. Under these assumptions, arbitrage process operates as follows. Under these assumptions, arbitrage process operates as follows. Number one is that the investor will sell his ownership. The investor will sell his ownership. The investor will sell his ownership in the overvalued company. The investor will sell his ownership in the overvalued company, and realize the benefits. The investor will sell his ownership in the overvalued company and realize the benefits. Then step number two is that the investor will then borrow. The investor will then borrow on the personal account. The investor will then borrow on the personal account. The amount equivalent to his percentage of ownership. Amount equivalent to his percentage of ownership. Amount equivalent to his percentage of ownership multiplied by amount of the debts. Multiplied by amount of the debts. Multiplied by amount of the debts in the capital structure. Multiplied by the amount of the debts in the capital structure. Multiplied by amount of the debts in the capital structure. The number three is that the investor will then make comparison. The investor will then make comparison. The investor will then make comparison of the proposed income. The investor will then make comparison of the proposed income from the current farm, the new farm, the proposed income from the new farm, the proposed income from the new farm, the proposed income from the new farm, and his current income, and his current income, and his current income from the current farm, and his current income from the current farm, and his current income from the current farm. Then finally, the step number 4 is that the investor will then invest. The investor will then invest in the company. The investor will then invest in the company where his returns are maximum. The investor will then invest in the company where his returns are maximum. The investor will then invest in the company where his returns are maximum. So those are the steps of practicing the arbitrage process. So I want us to use a question to see the argument by M and M. So check the question for November 2017, question 4, part B. We check the question for November 2017, question number 4, part B. November 2017, we check a question for the sitting of November 2017. November 2017, question number 4, part B. So November 2017, question 4, B. So when you go through that question, question number 4, part B. So you check on page 45. When you check on page 45, there is a question number 4, part B. There is a question number 4, part B. So that question number 4, part B, that question number 4, part B, it reads that the following data relate to 2 companies. The following data relates to the 2 companies, Alpha Limited and Beta Limited, which belong to the same risk class. Which belong to the same risk class. So they gave you Alpha Limited and Beta Limited. Number of the ordinary shares outstanding, you are given 90 millions and 150 million respectively. Market price per share is also given. Then 6% debenture market value is also given. Profit before interest and tax has also been given. So all the profits after debenture interest are distributed as dividends. So required, using the suitable calculation, demonstrate how under Modigliani and Miller, approach without the taxes. An investor holding 10% of Alpha Limited shall be better off switching his holding to Beta Limited. So we shall simply be practicing the arbitrage process. Those steps I've given you when he shifts from the overvalued to the undervalued, and see what will be the benefit from there. Then Roman letter 2, explain when according to M and M without the taxes. The process described in part B, Roman letter 1 above, will come to an end. So when it comes to investment matters, M and M was able to advise that when companies are identical means they have the same operating income. So if 2 companies have the same operating income, they should attract the same value. The value should be the same. But M and M argued that in case they attract different values, you need to practice the arbitrage process to restore the returns of the 2 companies to equilibrium. So you want to know how to restore that. But first, we need to know the value of the two companies. We should know the value of the two companies before we determine which one is overvalued and which one is undervalued. So value of the firm. Value of the firm should be given by value of equity. Value of equity. Then we add value of the debt. So value of the firm will be equal to value of equity. We add value of debts. Value for the debt. So there are two firms, Alpha Limited and Beta Limited. Alpha Limited and also Beta Limited. So we start with market value of equity. We start off with market value of equity. We start off with market value of equity. When you check under Alpha Limited, market value for equity, the number of the ordinary shares are 90 millions. The number of the ordinary shares are 90 millions multiplied by the current market price. Market price per share is given as how much? They were able to give you 18 million. So when you multiply, we should be able to come up with what should be the value for that. That's the middle figure. Forget about the M. You want to know the value should be how much? 1620 millions. Yeah, so we should be able to get 1620 millions. That's now for Alpha. Then for Beta, there are how many million shares? 150 million shares. And also multiplied by the current market price, which is how much? 10. So we should be able to give us how much? So it will be able to give us 1,500 millions. So that's now for the market value for equity. We also add there market value for the debt. We also include, so market value for the debt is meant to be the debentures. So we also compute market value of the 6% debentures. The 6% debentures. So this one was given. Alpha, they gave you which year? For me to pay 60 millions. Then, zero. So when we add, we shall now be able to get the value for the farm. When we add, we shall be able to get the value of the farm. Value of the farm. So this value for Alpha, it is how much? It is 1680 millions. Now we will remain. Yeah, so from that point, Alpha is overvalued. It has a higher value than Beta. Then also, this one is levered. Alpha is levered. This one is unlevered because it has only equity. So the two firms, Alpha is levered, it has both equity and debt. Then Beta, it is unlevered because it has only equity. So according to M and M, these two companies are identical because you can see their operating income. You can check where they gave you the figure for the profit before interest and tax. The profit before interest and tax, they have given us 18 million and 18. Then when you check in the first paragraph, they have the same, they are in the same risk class. So those two companies are identical. When they are identical, this value is supposed to be the same. They are identical because operating income is the same. They also operate in the same risk class. So the two companies are supposed to have the same value. But now when we compute, Alpha is having a higher value than beta. So we need now to practice the arbitrage process to discover that the returns of these two companies will be the same, not in terms of the market value, but the returns for the investor. The returns for the investor will finally be the same. Whether you remain in alpha or you go to beta, your net returns will not change. So M and M was able to prove that. So you want now to prove that, to know that whether you remain in alpha or you go to beta, because this investor is currently in alpha, but he is planning to go to beta. So what are the net benefits from there? So also before we practice the arbitrage process, we need to get the cost of equity for alpha and also cost of equity for beta. So we can compute cost of equity of alpha limited. Cost of equity for alpha limited. So cost of equity for alpha, because it is levered, it is the same as KEL. KEL is the cost of equity for the levered firm. Alpha, it is levered. In the previous class, it was meant to be given by earnings before interest and tax. We subtract interest. Then 1 minus the corporate tax. We divide by value of equity. We divide by value of equity, then we show it as a percentage. So the cost of equity for the levered firm, because alpha is levered, so cost of equity will be the same as KEL. You take the earnings before interest and tax, we subtract interest, 1 minus the tax rate, we divide by the value for equity, then we express it as a percentage. So earnings before interest and tax is given. Are you able to see the operating, the profit before interest and tax? For alpha, it is given as 18 million. So we need to subtract interest. So interest, you can see the debentures, 6% of 60 million. The debenture is 60 million, so interest rate is 6%. So what should be 6% of the 60 million? Inakuja 3.6 million. Yeah, so it will be 3.6 million. Then the question is saying without the tax. You can see somewhere about without the tax. Yeah, then we are supposed to divide by the value for equity. Value for equity is the same as this figure. You can see the value for equity for alpha. It is 1620. So yeah, this one here. It is 1620 meters. Then express it as a percentage. So value for equity is this one here. For alpha, the market value for equity was 1620 million. So that figure has some decimal points. Yeah. When we shall be requiring it, we will go back and get the exact one. When we shall be required to use it. But I know it is 0.88 recurring. But when we require it in the step, like after some few steps, we shall go back and get the exact. Because we want to practice arbitrage process. If you round off, it will never balance. So when we shall be requiring it, you have seen how to calculate it. You will go back and get the exact, so we apply it. But for now, it is simply 0.88 recurring percent. So we can just have it anything in that manner. We can still round it off. But when we shall be requiring to use it, we require the exact figure. So that is now meant to be the cost of equity for alpha limited. So we should also compute the cost of equity for beta limited. We should also come up with. So there was no tax. You remember that in the question? Without the taxes. Without the taxes. So We also compute the cost of equity. Cost of equity of Beta Limited. We also compute the cost of equity for Beta Limited. So cost of equity for Beta, it is unlevered. It means we get KEU. KEU is the cost of equity of the unlevered firm. It is simply earnings before interest and tax. So this time there is no interest. We divide by value of equity. Then we express it as a percentage like that. So KEU is meant to be the cost of equity of the unlevered firm. So both of them were having the same profit before interest and tax. So what are we given as the profit before interest and tax? It is also 18 million, but they say there was no tax. So the tax rate is 0. Then we divide by value of equity. Value for equity is this one here. Yeah, which is the same as the value because it was unlevered. So value of equity is 1,500 million. So this one is exact value. That one is meant to be exact. In a prepare which percent? 1.2%. So those are simply the workings. So now after our workings, we want now to practice the arbitrage process. We should now be able to practice the arbitrage process to see that there is no need of you moving from one company to another. The returns will finally be the same. So this is now the arbitrage process. This is now our arbitrage process. So we start with the step number 1. We start off with the step number 1. So from the note's perspective, we have said in the note number 1 that investor is supposed to sell his ownership in the overvalued company and realize what amount. You can see that step. So maybe you can just write something on that step 1. So step 1, you can note that the step number 1, we can summarize that the investor will sell his percentage of ownership. The investor will sell his percentage of ownership. The investor will sell his percentage of ownership in the overvalued firm. In the overvalued firm and realize the amount. The investor will sell his percentage of ownership in the overvalued firm and realize amount and realize the amount. So this is now the amount realized. Amount realized. Amount realized. So amount to be realized. You can see they say he owns what percent? Yeah, just check in the Roman letter 1. An investor holding 10% of which company? Alpha. So we get 10% of alpha. And in the company, we own equity, not debts. We own equity. So equity is 1620. We get 10% of 1620 millions. Yeah. In any company, a shareholder will own ordinary shares, not this total value for the company. Your ownership in a company as a shareholder is calculated on equity. So you get 10% of the value of equity, which is 1620 millions. So that means you will be having how much? 162 millions like that. So that is now our step number 1. Because he wants to move to Beta Limited, he must sell his ownership in the Alpha. So what was his value in Alpha? that he was meant to sell. So you sell 10% of your value of equity. So we go to the step number 2. We now check the step number 2. So step number 2 is that he would then borrow. So step number 2, we write that he would then borrow an amount equivalent to. He would then borrow amount equivalent to. He would then borrow amount equivalent to. So this is now the amount to be borrowed. Amount to be borrowed. So amount to be borrowed, it will still be percentage of ownership multiplied by the amount of the debts. When you check in the step number 2, we say that equivalent to his percentage of ownership multiplied by the amount of the debt. So debt is how much? 60 million. So get 10% of the 60 million. We get 10% of the 16 million. So that should be able to give us how much? It will be 6 million. Then, still on that, you can now add there a paragraph. Still on that step, you can now add there a paragraph by noting that. Therefore, the total amount available for investment. Therefore, the total amount available for the investment, will be equal to. So you take 162 millions plus the 6 million. 162 was the step number 1. The 6 million is in the step number 2. So you add them together like that. So that is now our step number 2. Then now we got the step number 3. So step number 3, we note that he will then invest. He will then invest. Step number 3, we note that he will then invest in the undervalued firm as follows. He will then invest in the undervalued firm as follows. He will then invest in the undervalued firm as follows. So he wants to invest. He wants to invest in the undervalued firm. The undervalued firm is Vita Limited. So we start with amount available. Amount available. Amount available. We have seen it is how much? 168 millions. Is it 168? Yeah, the total amount available for investment. It is 168, isn't it? Then we less amount to invest. We less amount to invest. So how much is he going to invest? Remember, he should maintain his percentage of ownership. He should maintain percentage of ownership. So we know he was owning what percent in this other company? 10%. So when he goes there, he should also only own 10%. So when he maintains his percentage of ownership, amount to invest will be 10% of the value of equity for Vita Limited. The value for equity for Vita was 1,500 million. So multiplied by the 1,500 million, so that he maintains the percentage of ownership, even in the new farm, so that he maintains the percentage of ownership in the new farm. So it will give us how much? 150 million. So when you subtract, what will be the balance? So you will be having a balance of what? 18 million. So now we go to the step number 4 after that. So when you maintain the percentage of ownership, the balance is 18 million, isn't it? Yeah, so now we go to the last step by noting that he will then compare his returns as follows. 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 So you want now to compare the returns from the two firms. You want now to compare the returns from the two firms. So among the two firms, there was Alpha Limited. There is also Beta Limited. Like that. So we are now comparing the returns from these two companies for the investor. So we start with the return on equity. Return on equity. We start with the return on equity. So we are in the Alpha Limited. We are on the Alpha Limited. So when he was in Alpha, what was his value of equity? Remember the step number one. What he sold was his ownership. So that figure was how much? So it was 162 millions. Yeah, that was his value of equity when he was in what? In Alpha. So what was the return on that equity? We calculated the cost of equity. Ile figure ndio waambia msround off. Remember that figure? Yeah. So nataka mchukue hiyo figure mkue nayo kwa calculator, the full of it. Get that figure. You remember KEL. So online, I want you to go back and get that figure on your calculator. Calculate KEL. The cost of equity for Alpha Limited. Remember, it was 0.88 recurring, isn't it? But now I want you to have it on your calculator. Once you have it on your calculator, multiplied by 162 millions. Multiplied by 162 millions. And see, it will give us which way. It was something to 88 something percent like this. So when you get that exact figure, don't use mine. Mine is not complete. Get the exact figure on your calculator. Then you multiply it by 162 millions. And see, it will give you which figure. And 44. Hii ingine ni percentage. Sasa divide by 100. See, ingine ni percent. So divide by 100. Yeah, the 0.88 recurring is a percentage, but we want that figure in shillings. So divide by 100. So online, manapata ngapi? It is 1.44 millions. You will be able to get 1.44 millions like that. So that will be now return on equity when he is in Alpha Limited. He owned 10% and the amount he was owning was 162 millions. So what was the return on equity? You simply take that value of equity multiplied by the cost of equity. Then we go to beta. We go to beta. We also want to get the return on equity for beta. Now, I was asking, are we getting that value? Yeah. So now we check for beta. So beta, I want you to go to the step number 3, the amount he invested when he maintained the percentage of ownership. When you go to the step number 3, if he maintains his percentage of ownership, what was the value of equity? Ilikuwa 150 million, isn't it? Yeah, so we calculated KEU. You remember the cost of equity for beta? It was what percent? It was 1.2%. So when you get 1.2% of 150 millions, atapata ngapi? It will be 1.8 millions. It will be 1.8 millions. Then now after that, because there was borrowing somewhere, with less interest. With less interest. When you borrow, you must pay interest. Interest will reduce your returns. Interest is meant to reduce our returns. So he had not borrowed. He had not borrowed when he was in alpha. He only borrowed when he was moving to invest where? In beta. So there will be no interest when he was still in alpha. When he was still in alpha, there will be no interest. But when he was moving to beta limited, there is an amount he borrowed in the step number 2. Remember our step 2. He borrowed how much? He borrowed the 6 million. Then what is the interest rate? It is 6%. It is meant to be 6%. So what is 6% of the 6 millions? 6% of the 6 million should be the same as 0. So now we are subtracting to get the net returns. To get the net returns. Net returns. Get the net returns. So this one will remove 1.44. How about the one for beta limited? Here itakuwa ngapi? 1.44 million. So this is the advice M&M was giving you. Whether you move to the overvalued farm or you remain in the undervalued farm, your net returns will remain. Your net returns will remain. So there is no need of you moving from one company to another company, seeking to get higher returns. The advice by M&M is that when you buy shares of a given company, as long as it is stable and it is regulated by the same security exchange market. Like now in Kenya, all our companies are regulated by the NAIROBI Security Exchange. So all those companies, when you buy in their shares, your returns will be the same. I can give you an example of 2 companies, Safaricom and Kenya Breweries. I know there's a big variance in the share price. Safaricom, the share goes at how much? Inaenda pesa ngapi saizi? All of you uses the services of Safaricom. What is the market price today for Safaricom? One share is around how much? It has been fluctuating around 40 shillings, but you can get the exact one. It has been around it is almost around 40 shillings. It fluctuates along that region. Kenya Breweries, their share price is almost 450. If you check, it also fluctuates around that region. So don't be motivated that maybe Kenya Breweries pays better dividends than Safaricom. That is not true. M&M said that when you analyze it critically, so here I will buy 1 share. There I will buy 1 share. But in Safaricom, I will buy how many shares using the 250 shares. When you take 250 divided by 40 to give you, it will give you 6. So dividend per share in Safaricom will be 1.5 shillings. Dividend in Kenya Breweries is 10 shillings. So total dividend finally will be the same. Pale utachukua 6 multiplied by 1.5. Itakuja how much? When you take 6 multiplied by 1.5, it is almost the same, isn't it? Because of the issue of the rounding off. So finally, the dividends from these 2 companies will be the same, because hapa utanunua 1 share with your 250. Na pale utanunua how many shares? 6. So M has advised you that the only thing you need to consider in a company is stability. If the company is stable, don't rush to buy a share from a company whose price is too high, because you buy fewer shares. But when you go to the company where prices are lower, you will buy many shares. So finally, your net returns will remain the same. That's the argument by M and M. They were advising you that whether you buy the shares of Kenya Breweries or the shares of Safaricom, finally your net dividend will be the same, or net returns will be the same. There you will buy one share at 250. So when they pay 10 shillings, you are getting a lot of money. But you could more shares. When you multiply by dividend per share, you still have the same. So M and M was advising you, there is no need of you moving from alpha to beta. Finally, the net returns are the same. Yeah. Okay, the exchange rates to the same. The value of a Kenyan shillings and the value of Ethiopia. If finally you go into the currencies, you will get the same. The challenge with our KQ is stability. I've put it there, the question mark, stability. Yeah. When all of them are regulated by the same security exchange market, and they are performing as per the standards. You see, the dividend is determined by the management. So management for KQ, they will decide not to pay you. So you end up not getting, but in the real scenario, they are supposed to pay you because you bought their shares and they have been doing what? They have been operating. So wale wa Ethiopian Airlines, but our KQ watachukua. So finally, there is no money to distribute. That's now the question mark where it is. So if all of them were operating with the same management, who are there to work as managers, not as business people. I hope you are not going to manage as a business person. So when people are there as business people, they will not operate effectively because they want to make their profit from there. But if you are employed as a genuine manager, these companies are Kenya size banks, cooperative bank, KCB, you see how they are paid, so that you don't take their money and just do your management. So they will pay you their salary. It is too high, yes, but it's after they have deducted from their profits, isn't it? So finally, the shareholders are paid their dividends from that point. So have someone who is a manager, not a business person, as a manager of the business. So Kenya Airways, they are not managers, they are business people. But those Ethiopian Airlines, they hire managers. So when you buy shares, don't look at the share price. Look at the stability of the company. Even if the share is going at 2 shillings, just go and buy, because you will buy many of them. Then in the process, if they make profit, they will calculate the profit on the basis of the shares, and they will get enough profit as compared to this other firm. So this is now the argument by Modigliani and Miller. So don't be interested that when I'm working in Safaricom and someone else is working in these other companies, Airtel. So don't feel that you are working in a big company. Look at your salary. As long as your salary is good, where end up finding that, watch out in Safaricom because it's a big company. Finally, at the end of the retirement age, the retirement benefit. So as long as the salary is good, don't look at the name of the firm. Just look at your salary, because finally your lifespan will be 60 years. So if someone is paying you 20 and another one is paying you 100, go for that 100. The company is in the river. Just go there. There is no problem of missing you going to river, but in the evening you come back with more money than missing you going to this other side, but in the evening you come back without money. So that is the concept by M and M. They argue it in terms of returns, not the name or the image of the firm. So now after that, we should also come up with the arbitrage gain. We should also be able to look at the arbitrage gain. So those big companies sometimes they are not the best. When the scandal comes up, all of you will go home. And they are the ones which gets the scandals. So this one will be net income from the new firm. Then you minus the net income from the current firm. So you want now to get finally, what should be the arbitrage gain? Finally, we look at the arbitrage gain. So when it comes to the arbitrage gain, finally, we shall be getting the net income from the new firm. Now we minus the net income from the current firm. So new firm is beta limited. New firm is meant to be beta limited. So here we shall be assuming he invested the full amount. We shall be assuming he invested the full amount. That full amount was 168. So if he invested the full amount in the new firm, it will be 168 millions. You remember KEU? It was 1.1%. It was 1.2%. So multiplied by 1.2%, but you still have to subtract the interest from that new firm. That interest was 0.36 million, like that. So that now will be the net income from the new firm. We assume that he invested now the full amount. Then subtract the net income from the current firm. This one will just remain 1.44 million. For the current firm, which are just that amount. But for the new firm, we now give you the opportunity to invest the full amount. So you should not have the balance. So now assume you have invested the full amount. So this one will be 1.44 million. So that is now what will be the arbitrage gain. That's now what will be the arbitrage gain. From the new firm, assume now that you invest now the full amount. Invest the full amount, which is 168 million, multiplied by 1.2%. But still, you had borrowed, you also have to subtract 0.36. Then now, the net income from the current firm, that one will just remain 1.44 million. And get now the arbitrage gain. Then now you can now be able to come up with the arbitrage gain from that point. So that is only for demonstration, but the entire process ended at this point because the net return are the same. Here we are simply looking at what is the arbitrage gain from the two areas, because even this extra, you see this balance, you could use it in something else. So what will be the net arbitrage gain on that level? So we are getting 216,000. That's now the arbitrage gain. So finally, there was the Roman letter 2 of the question. Finally, there was the Roman letter 2 of the question, where they were asking that, explain when, according to M and M, without the taxes, the process described in part B, Roman letter 1 above, will come to an end. So we can now comment that we can now comment that the process will come to an end. The process will come to an end at the point of equilibrium. The process will come to an end at the point of equilibrium. At the point of equilibrium, where the returns of the two companies are equal. The process will come to an end at the point of equilibrium where the returns of the two companies are equal. When the returns of the two companies are equal. When the returns of the two companies are equal. So that's now how to go about the entire process. So on Saturday, we shall still be meeting Mwalimu atakuwa mwalimu wa leadership. So remember, we shall also be meeting on Saturday afternoon, because last week we had the class, so this time it is supposed to be leadership, but he will not be around. So remember to attend. I will be there on his behalf. But just on financial management. That is on Saturday at 2. So you can stop there for now.
Mel, desculpa, só para. Se fanya haraka wasitumalize hivyo.
Calma.